is good. We are live. We're going to be talking about Silicon Valley Bank and what actually happened with them. Probably heard it all by now, but there's going to be a little bit different take on what actually took place or why it takes place, and then what I believe this kind of like pushes us towards from a national bank. Like that means the United States government owns the banking system, right? There, it's, you could say quasi right now, but actually nationalizing the banking system, right? So do we want to move in that direction? And how that can lead to CBDC, but also what type of impact is this going to have on crypto, on real estate, and on gold? Like I'm not even considering stocks or bonds because I wouldn't put my money in there. Not saying you shouldn't, but things that are much more tangible. Yes, you could say crypto is not tangible, but real estate and gold can be very tangible though. So with that being said, if this is your first time here, what's good? My name is Sam. If this is your second time here or we're returning, it's good to freaking see you. And if you'd like to support the channel, you can check out the links down below or other socials. Now, without further ado, let's get into the show. So, Junior, what's good, bro? Appreciate you stopping by. So I pulled up something. We have SVB, right? Well, there's actually 3 bank failures. SVB, I think it was Silvergate and Signature have all been closed. And the reason why this happens is pretty simple. Think of a business. What is a business? It's cash in. It means money flowing into the business. That's all it means. Cash in. The business is extremely simple. Cash in. You gotta get cash in the door, period. Right? The less you put out the door, the more cash you have in the business is profit. Cool, right? Okay. Bank is no different. And they stopped having cash coming in. But it wasn't necessarily because of a bank run. And to start with this goes back to 2020. I didn't look up the actual reserve ratios, but just I can do a quick Google search on that. And it's related to the reserve ratios of banks. So the fractional reserve system. Let's see if we can find it. SVB bank reserve ratio over time. Let's see if we can pull this up and then we can share this with you guys. One day ago at first glance, SVB. Okay, so I'm going to pull up the website real quick. Let's see if, can you guys see this? Nope, that's actually what we're going to get to in just a moment. So let me share this tab. There you go. So this is SVB's bank, Silicon Valley Bank. You can see it up here. Commercial, private, investment, assets, right? Clients' funds, over $1/3 of $1 trillion. Established not too long ago, right? 83. Okay, so I don't think they're going to have it in here, or at least have to do a lot more digging in order to be able to actually pull this up. But fractional reserves, right? What does that mean? You probably have heard of fractional reserve or the Federal Reserve for banks. So that means that, you put in $1 million of deposits from customers into a bank, and they will take that money and they will loan out, say, 90% of it, or $900,000 of the $1 million in deposit to somebody else, right? That other person's going to use it to buy a house, or they're going to use it for an investment purpose or something along those lines, right? And the tucked in the very bottom of the press release on March 15th, 2020, this is the Board of Governors of the Federal Reserve System, right? So This release was in 2020, but right here, way down here at the bottom, it says, in light of the shift to an ample reserves regime, the board has reduced reserve requirement ratios down to 0% effective March 26, the beginning of the next reserve maintenance period. So this is at the very bottom of the press release, right? The last paragraph. They sneak this in here. And they let you know that there's no reserve requirement. So that means the $1 million that comes in as a deposit to the same bank, it used to keep $100,000 as a reserve in case customers came in and wanted their money. Now, it doesn't. That was 3 years ago. That means they're more risky. The entire system is more risky. The entire system has way more debt. Or if you understand like what dollars are, they're just debt, right? That's why I say that there's just more debt. In 2020, we're not a fractional reserve system anymore. We're a 0% reserve system. You don't need a reserve dick all. Right? And that was in 2020. So the bank can now take your $1 million in deposits and loan that out to somebody else. Now, what happens with the bank? So that's the first issue, right? The whole entire system is more risky. The whole entire system is that much closer to collapsing, that much more fragile to what's about to come, right? Because the balloon is going to get so big, right? The balloon, you're blowing it up, it gets bigger, or you can see it stretching, right? And you see the balloon like silicone or whatever, and it looks like it's getting so tight as you blow more air into it. And then you take one more breath to blow in the balloon, and bam, the whole thing pops in a second, right? The system is getting to that point that is not good at all. And that takes us to SBV or SVB, right? Silicon Valley Bank. Remember what I said of businesses: cash in. So for them, cash in is deposits. And that is a liability on their balance sheet. And their loans and or treasuries are going to be assets because they're getting paid from those. The cash is not. So you're giving you're giving the bank an interest-free loan on your money that they make money on, and then somebody else takes your money and makes money on that, right? I'll take that and buy an investment property. So how did they collapse? Well, remember, the one is a liability. That's your deposits, right? And the other is your assets. So they had assets that were treasuries. And all treasuries is a promise to pay in the future. If you've never heard the term time value of money, what's good, Jack? Great to see you, bro. Time value of money. If you've never heard that term before, I made this to create like a little example here. We're going to use blue. Let's say I were to give you the option of $1,000 today or $1,000 in 3 years from today. Which would you prefer? The $1,000 today or the $1,000 in 3 years from now? Well, if you have any functioning gray matter, you're going to take the $1,000 today. Why? Simply because they're not equivalent. Why are they not equivalent? Because if you take the $1,000 today, you invest this, let's just assume for easy math, at 10%. And then you compound that up into the future. Let's just say this is 1 year. This will be easy math then, right? Whoops. For this is just 1 year, right? What do you have? You now have $1,100. So when I say, would you rather have $1,000 today or $1,100 or $1,000 in 1 year, you would rather have $1,000 today because you understand $1,000 in the future is less valuable. And here's why. Because you can take the $1,000 today and put it in, say, Hex or something like that, and earn 10% on it. So throughout the year, at the end of the year, you now have $1,100. So now this is where the seesaw balances. It is at the $1,100 mark and the $1,000 mark where you are equivalently saying, I don't care if I get $1,000 today on this hand, or if I get $1,100 in a year from today, because in your mind, they are effectively equivalent. We're not going to get into how you can calculate the interest rate, right? But we're going to use 10% as Hex as an example here. But you could adjust this with the 3% if that's how you want to invest in like treasury type stuff. You could invest in real estate at 25% if that's how you do things. Like you can pick different rates based upon your investment perspective and options available to you. Okay. So SVB, how does this tie into SVB, Sam? Okay, well, let's go through here, take some of these things off here. Let's take all of the, whoa. And if this, I guess this is not gonna let me do that, so never mind. Okay, so let's go back through. And they took these treasuries, SVB Bank took treasuries. These are just promises to pay you. Here, Bo, I promise to pay you in the future, but it's from the government. So it's called a bond, right? But it's just, I promise to pay you in the future some interest rate. And interest rates are inversely related to price. And the reason is because, let's go through and take the same example, but instead, let's change the color of the interest rate so it'll be more effective. Let's use orange. So instead of you saying 10% is the interest rate, right down here. Whoops, it's back to blue for a second. I thought I just changed this. Thank you. We go. Instead of 10%, let's say it's 20%, right? How do the numbers change? Whoops, that's supposed to be a 0. Well, let's just do the math. Take $1,000, invested for 1 year at 20%, you now have $1,200, right? So to be equivalent, meaning would you rather receive $1,000 today or $1,200 a year from today, right? Those would be equivalent. If you said, would you rather receive $1,100 or $1,000, given that the interest rate has gone up, what would the rational, logical person do? They'll take the $1,000 because the $1,000 is $100 more valuable than the other one in a year from today, right? And you can, we're thinking about things in the future, but you can just do the same exact calculation and bring these things back to the present. That's called your present value. You can calculate your future value. So how does this relate to SVB? Well, SVB has these things called treasuries on its balance sheet. And it needs to mark these to market periodically, or it does transactions in the market, which also inevitably marks things to market. Sam, what does mark to market mean? Well, if you have a asset on your balance sheet, an easy example might be a piece of jewelry or a fine piece of art, like the one on the wall there. At some point, I have to mark this beautiful display of art on my balance sheet at a certain value for tax purposes or for other reasons I might want to do that for. Maybe collateral reasons, taking out a loan. There's a bunch of different reasons why. And with the banking system, I think it's required every so often if it hits certain triggers. So I go to an appraiser and I get my picture here quoted, right? They're gonna give me a price. What is the market value of this? That's what marking to market means, right? Let's take this for example, right? Bought this at Aldi's for $4, for $5. So how much do you think it's gonna be worth? Well, the guy's like, well, it's open now. All the other letters are missing. $2.50, right? So I have it on my balance sheet as an asset for $5 because that's what I bought it for, right? But it's actually only worth $2.50. because I lost all the other letters to it and it's already opened and there's dings on it and it's covered in dust, right? Well, SVB has all these treasuries that change with interest rates, as we just saw. What has happened with interest rates? Interest rates have gone up. What did we just look at in our example? What happens when interest rates go up? The trade-off between the future thing and today's dollar have to change, right? So when you look at this example, we're talking about things in the future, right? If interest rates go from 10%, the Fed now raises them to 20%. The investments that you could make are stronger, or another way to say the same exact thing, if you look at it from the PV standpoint, PV is present value, is that the present value of the thing has to be traded at a lower price if you hold 1100 constant. So that's a fancy fucking way for people who didn't understand that, to say that if you were to say you receive $1,100 in a year from today, no matter what, and then tomorrow interest rates go up by double, right? It goes from 10% to 20%. The next person, the exact same thing that you have, is now valued at $1,200, right? So your thing today is worth not $1,000, even though they just use $1,000 from tomorrow. Remember, these are arbitrary things. They're paper that trades. This is the math. Well, we can get into the math if you want to, but like, this is the logic you need to understand how bonds trade or how this bank stuff works. And so your $1,000 that you put in yesterday to equal $1,100 a year from today, and then interest rates go from 10% to 20%, your $1,000 tomorrow is worth way less, substantially less, because it's a piece of paper that's called a treasury, and that treasury went from $1,000 investment down substantially because it's not worth $1,200 in the future, like everybody else's new $1,000 that comes in today. It's worth the $1,000 from yesterday with lower interest rates. So the only amount that you're going to get in the future is $1,100, not the $1,200. So somebody is not going to pay the same price. So they're just not going to pay the same price for something, which means the value is lower. And you can do the math on this. Like basically, if you take, and this might be easier for the math guys in here. Let's use a different color here. I'll show you exactly why this is. Let's use green. Okay, so let's take this 1,100, the same exact example. I use a calculator now, though. We're going to take the 1,100 at the new interest rate, and we're going to bring that back to present value. So what I'm going to do is take 1,100 divided by 1.2, right? And what all that is this plus 1 to discount it back to the present value. So what this equals is 916. Boy, you guys are getting this shit. This is stuff that they teach in finance courses and whatnot. But the price today would be, $916, if you can read my writing here, $916, right? And the reason is just simply because of the math. You can pull up your phone calculator, right? You can turn your phone sideways and pull up your phone calculator and do the math, right? Look up a present value calculator or just do the math simply just by plugging into your effing phone. It is really simple. And you get to see exactly what I'm talking about. This is the price here. So you put $1,000 into this investment called a treasury, and rates have doubled, and now your investment has gone down from $1,000 yesterday to $916, right? Well, Sam, you talked about SVB. Okay, let me get to SVB. So SVB has these treasuries. They get depositors' money, right? And they pay them diddly squat. And then they take customers' free loan, yes, free loan to the bank, and they take that money and they buy treasuries that are yielding 4%, or say 2% or 3%. So they pay the customer diddly squat, And then they take that and they buy treasuries, right? And treasury were trading around zero, right? A couple years ago. And then over the last like 18 months or so, the Fed has taken the fastest and most aggressive rate increase ever to the point where we are now. So that means that back in Volcker's days, they didn't even raise rates as quickly as they are right now. They're raising rates faster than they ever have in history. And when you understand what we just talked about, the math behind these treasuries. So they take all these treasuries and all these treasury that they bought a year ago, but they might actually be 2 or 3 or 4 years to expiration, meaning it's a 4-year bond or a 3-year bond or a 10-year bond or a 30-year bond. That means the further into the future you go, the bigger the impact it has on the price, right? We did 1 year. Look at this. We did 1 year here. This is a 1-year discount rate. If you do a 2-year discount rate and you keep it at 20%, the math, I'll tell you what it is. It's $763.89, right? This is supposed to be 88 cents actually. 88 cents, right? So the price goes down drastically, and this is a 2-year time frame. So I don't know what the average length of the bonds were that SVB had, but every time the Fed raises the rates, the banks that hold these treasuries go down in value. So remember this. Depositors' funds are liabilities to a bank. Loans and treasuries are an asset. So you have assets and liabilities. And what happens when your assets go below your liabilities? You go out of business. Right? Because you owe more than what you have. And when you look at what's happening, and if they're exactly the same, if you have any abnormality in terms of people taking money out of the bank, you're fucked. That's a technical term. That means bend over. And when the Fed raises rates by 0.25% or a 50%, you don't have to be super fucking smart to understand this. I'm using a 20% rate here to kind of exaggerate it so that you guys get to see the big price differential between $1,100 and today's price. But you can do the math at say 4%, right? And then going to 4.75%, right? So let's just do the math right now, and we'll say that instead of $1,100, let's say it's $100 billion, right? Because that's what they said. They had $300 billion of like loans or other things on their balance sheet, right? So let's say they had $100 billion of treasuries, right? That's 1 followed by 11 zeros. So then we're going to take that, we're going to divide that by 1.045, right? So that's $94.5 billion, right? So $94.5 billion, $100 billion in say 1 year from today, $100 billion that the Treasury is going to pay out in 1 year from today is only worth $95.4 billion today, right? Okay. So now remember that 94.5 billion. Now let's go back and say that it was 2%, right? Because that's where it was, let's say, a year ago. So you get to see the damage or the reduction in asset values from these things. We're going to do the same exact scenario. We have maybe I can share my calculator so you guys can see the difference. It's massive here. That's what she said. Just trying to share my calculator screen with you. Here we go. Okay, so you guys can see the calculator screen. Okay. We've got $100 million, $100 billion, right? So we're going to discount this at 1.02. This is a 2% interest rate. So remember, treasuries a year ago, 18 months ago, whenever it was, were 2%. We'll just assume that they were actually lower than this. So what does that mean? Today's value is the price in the market should be almost $98 billion, right? So that means 1 year ago, you had $98 billion. And then the money you had on your balance sheet, the Fed raises the rate to 4.75, right? So we're going to discount this, and your 98 billion goes down to 95, right? And so when these companies operate in these margins where you have interest rates going up, that means assets are going down. What do you think? Like, if you're paying attention to crypto, then you probably already understand this. But what do you think intelligent, rational people are doing with their money? Do you think that they're storing it in banks as deposits? No, they don't do that. They store it in assets, right? What's an asset that we all know is going to have a giant fucking impact in the future? I don't know if you can read the name above my head. It says crypto for a reason. And that's because crypto money is flowing into crypto. Money is flowing into crypto. Money is flowing into real estate. Money is flowing into precious metals. Money is flowing into currency. Some people, not my opinion, is a good idea, but money is flowing into the stock market, right? And out of banks. Because the risk of being in a bank is tremendous, right? And now that we got a better understanding of SVB, how does this actually lead to federalizing the banking system or nationalizing the banking system? Well, what do we know about money? Well, money, currency, likes to centralize. Right? Because we can always come up with reasons why centralizing is more efficient, right? Maybe more efficient for price increases, maybe more efficient for XYZ or lower cost or this, that, and the other thing, right? So what do we know happens to money? Is that it centralizes? Okay, remember that, keep that in the back burner. Now, what just happened to the financial system? Well, I think it was the 15th or the 16th largest bank in America. There's fuckloads of banks in America. Just, again, that's a technical term for a lot of banks. Every state has multiple banks, right? There's probably more banks in Florida than there is in all of Canada. There's a boatload of banks in America. And one of the top 20 banks failed. And we had another, I don't know what ranking they were, but they were easily in the top 100. We had Silvergate and then Signature. So what do you think happens to the rational person who's going to act in their own self-interest, who has money and doesn't understand what's going on? That's a lot of people, right, who don't understand how Federal Reserve banking works, the fractional reserve banking works. They don't know how that works. They don't understand crypto. They know how to make money. Right? Maybe they understand a tiny bit about crypto. Maybe they understand a tiny bit about investing into other things. But they have a bunch of money. And in their mind, the bigger thing has more value. So they're going to move their money from the smaller bank to the bigger bank because the Fed has already said too big to fail. What does that mean? That means if one of the biggest banks in the country were to fail, the Fed would bail them out. So it means if they stole money from people through mismanagement, the Fed would just back them out. So you're fine, right? And so these people who have money, whether they're wage earners or have their own businesses, or they've just been investing for a long time, right? They're going to move their money to the largest banks. And this is not just me. I think I might actually be able to pull this up so I can show you guys. Bank of America increased deposits. So Bank of America, I think, is one of the top 3 largest banks. And okay, here we go. Perfect. Let me share this with you. This is an article from CNN Business. This is, I don't think, where I first found this one. Here we go. Facts in Silicon Valley. Here we go. Not that I would say you should turn to CNN for anything, but this is what this article says. I saw it somewhere else, and this is the first article that I could find that it seems to be in the title. Big banks experienced deposit spike after Silicon Valley Bank collapse. This is from March 15th, and it's today at 5:30 p.m. Eastern. So this is 2.5 hours ago. What did I say? I just fucking told you guys what was happening in the future. Nostradamus here. Nervous bank customers have rushed to the safety of big banks in the wake of a pair of high-profile bank failures that have shaken confidence in the system. Bank of America, Wells Fargo, Citigroup have all experienced a significant increase in deposits since Silicon Bank ran into trouble last week. People familiar with the matter tell CNN. By the way, if you guys are wondering where the CEO, the CFO, and the CMO all sold massive positions in SVB weeks before the collapse. They're not going to go to jail for fucking sure. They knew what was coming. They knew you were about to run into a effing wall, and they didn't do anything but take their money and run. They don't give 2 effing fucks about you. Period. Small and regional banks have suffered deposit outflows through a senior treasury, though a senior treasury official told CNN early this week that those customer withdrawals have eased. The situation is fluid, and it's not clear how much money has been plowed into big banks, though the sum is likely to be in the billions or tens of billions. Last Thursday alone, customers yanked $42 billion from Silicon Valley Bank, draining the California lender of all of its cash. By Friday, regulators shut the bank down, making it the 2nd largest bank failure in American history. In the last week, Citi has been speeding up account openings across retail banking, small business lending, and wealth management. A personal from familiar with the matter said. Here it is. Bank of America, this is the article that I saw the other day, or this morning, I think. Bank of America has raked in more than $15 billion in new deposits in the span of just days. That is a lot of money for them to bring in so quickly. Okay. Why is it an issue? If the money is centralized, what is the government going to do? They are going to get involved. If something gets too big, the government will get involved because they want control. And they will nationalize the banking system. That sounds pretty crazy to say in America. It's happened before. Look it up. And when they do that, it'll be easy because the government's going to control the banking system. For them to tell you that you don't have an account anymore and you need to switch to CBDCs, period. There's no ifs, ands, or buts about that. You need to switch, right? That's the direction we're heading. That's the direction we're heading. So how is this going to be good? Right? Doom and gloom, understanding how the bank works and like mismanagement of that. We went deep into that, right? And then understanding how capital's centralizing and the government's going to come in and nationalize everything. Well, why is this a good thing? Well, why is this a good thing? Because people who are listening to this or understand what's going on are buying fucking assets. TB Bishop, what's good, bro? I heard all 10 year anyway. at least was the issue. So 10-year for the treasury, maybe. Okay, so people are going to be dumping money into assets that they feel are safe. So my top 3, and this is not like 1, 2, 3, it's like 1, 2, large amount of space, 3 there, would be crypto first, real estate, and then precious metals. Because if you understand what is happening with the banking system, you don't want anything to do with the banking system. You probably don't want to hold gold either, because it's barely going to keep up or just keep up with your purchasing power. But if you want to increase your purchasing power, that means $1,000 today will get you $1,100 worth of stuff in the future, not how inflation is going like this and your wages are going like this. That's why your life is getting fucking more bad over time. to again, throw out another technical term, more bad over time. Because your wages are not keeping up with inflation for a lot of Americans. Your income needs to go faster than inflation. If it's not, figure out how to increase your income. Start a side business. Start your own business. Work harder. Get a sales job. There's 1,000 things you can do. Make more money. Has to be growing faster than inflation is. If you're getting 3% a year, if you're happy, cool. If you're not happy, do something else. You don't need to make 3% a year. You can get, 30% a month increases in your income. You need to do something else. Get into sales. Get into running your own business. Do something completely different. And then put your money into things that are going to actually do the same thing. Right? If you want to maintain your purchasing power, silver, gold, precious metals probably work great for you because they will maintain their value relative to USD in terms of purchasing power. But if you want to increase that purchasing power, meaning that is going to accelerate your position in the total pie of economic value, you go from this tiny little fucking speck of dust on the pie to a bigger amount of the pie in terms of financial or economic interest, do something like crypto or real estate, in my opinion, because then you're going to accelerate just like you would where if you figure CPI, your inflation is going up like this and your wages are going up like this, right? So that means your cost of living is going up faster than your actual income is, right? You don't want that. And the same thing with your assets. You want your assets to go up way faster than inflation. Not just up with inflation like gold might do. But with crypto, you can far exceed that. And then you're building a bigger portion of that pie. So that's all I got for today. If you guys have any questions, hope this is valuable. You can check out my other stuff as well if you're interested. I have links down below. If you want to check out stuff related to peptides and PED, that's performance enhancing drugs, and peptides are cool, awesome shit. In my opinion, you can check out my other YouTube channel, which should also be linked down below. I've got a podcast that's all around testosterone and PEDs. I usually have 2, but one of them I'm doing for quite a while now. And that's Too Much Test on all your favorite podcast platforms. You can check that out if you're interested in testosterone and hormone replacement therapy. Talk about all sorts of cool, interesting stuff on that show, and you can check it out. Leave a review if you do check it out. Appreciate you guys. Let me know what you thought of this, and I'll see you guys in the next video. Peace.